Welcome. Hello, clients and friends. Welcome to Capital Institutional Services monthly edition of our research call. Glad to have you here today. And today we're joined by Markets Policy Partners. They've been with us here on our monthly research call many times in the past, and we're glad to have them back. They look at the intersection of markets and policy, kind of looking at macroeconomic policy, macroeconomic factors, what's going on from a policy perspective in Washington. Then being located in DC, they kind of have their finger on the pulse with their backgrounds and their current connections. So I think it's a great time to have them. Particularly what's going on kind of from a macroeconomic standpoint. There's a lot to talk about in the world today. So Brendan Walsh and John Fagan are here with us. Brendan, how are you doing?
Excellent. Yeah, thanks for having us. It's always good to see you guys.
John, how are you doing?
Great to be back. Thanks for hosting us.
Absolutely, absolutely. So yeah, I said there's a lot to talk about. I'll let you guys kind of take the floor. Looked like we found out that inflation was maybe higher and maybe stickier than we'd kind of been led to believe a few months ago. So take it any way you guys want to, but I think that's something that a lot of people are excited to hear you guys talk about.
Definitely.
Yeah. We've just to roll the tape back, we've been on the sort of sticky inflation base case for quite some time, and this was informing our view that we basically put in place at the end of last year, that the Fed would start cutting rates in July, around the July timeframe, and do about 75 basis points of cuts. At the time, the base case was reflected in futures markets was a March beginning of the easing cycle, and about 150 basis points with upside risk to the Fed's rate cuts in 2024. Now, we haven't changed our view, and we've gone from wildly more hawkish than consensus to slightly more dovish than consensus.
Yeah,
and we're not changing. So we're watching the essentially the consensus run from one side of the boat that's tipping over to run to the other side of the boat. We think now it's kind of overshot in the other direction because we think that, despite the sticky inflation readings and the modest upside surprises that we've seen in first quarter readings, that the trends really are going in the right direction, even if we are in, over the medium to longer term, a structurally higher inflation environment, which is what we believe. But I'll let Brendan talk a little bit more about what we're thinking on the inflation front and how that informs our stasis in our current July start 75 basis point total 2024 cuts outlook.
Yeah, and even before the Fed kind of did their pivot at the end of last year, we kind of thought this was going to play out. But and the Fed did pivot a little bit before we thought, but kind of in retrospect, it seems like they looked at the calendar, they looked at their projections, and they thought, okay, we're probably going to start cutting in the summer. And it being election year, I think that they decided let's do it way early so that we're not seen as political, especially this year with everything that's going on. So then the market got way over its skis and it's like, oh, they're going to cut 8 times. And then now with inflation being a little stickier than they thought, the market's now like, oh, they're never going to cut. But we do think that they will cut, but not quite as much. But the situation that is facing the Fed is kind of two fronts. The housing numbers have been stickier than they had thought. So the real-time data has shown that both rental prices and housing prices have dropped kind of a lot over the last 6 to 9 months. But the way that the BLS measures it, they only check every 6 months, so it's kind of a rolling average. So those numbers are going to start to feed into the CPI, which is 40% of the core, and also the PCE uses the same measurement. They just weight it less. That's why the PCE has been running at a lower clip than the CPI. But those are going to feed in. It's just been feeding in slower than I think that the Fed had thought, because those numbers could be actually, zeros, which then would make the monthly number quite low. But more importantly, probably for the Fed, is that super core has been much stickier than we thought. That has nothing to do with housing. During the pandemic, goods prices went massively up, and then when we went back to the world, they came down. So they were negative. Now goods prices are flat. So flat is great and back to kind of normal, but it's not subtracting on a monthly basis from the inflation readings. But also the services inflation has been a little stickier than anyone could have ever thought. Car insurance, car repair has been really expensive. Some of the travel measurements have been higher. So those are kind of things that are real, not like weird methodology issues. So we do think that we'll start to definitely when the housing numbers start to feed in, those numbers on a year-over-year basis will start to feed into the year-over-year dropping, closer to the 2% that they target, and we'll allow them to cut later in the year. But the idea that they were ever going to cut in March, it was just not something we ever thought was possible, just kind of based on the data.
Yeah, and we expect, sort of paradoxically, almost the market's lack of faith and sort of, I guess, eroding hopes that the Fed is going to cut rates actually make it more likely that the Fed cuts rates. Because if you've priced in aggressive cuts and it, dutifully loosens financial conditions, then the Fed is, less able to actually take easing action because the market has done a lot of that work for them. If you're in a situation where the Fed keeps the market guessing, and they've got another couple of months of data, and things start to look relatively steady, they can start making the case that, hey, we think things are going in the right direction, but look, these are, we're at very restrictive levels, so we're just going to start to modulate, right? It may not be. We think that once they get into easing, they're going to try to dampen enthusiasm for like a massive and swift cutting campaign where they say, hey, look, we're going to take this one cut at a time, and we're going to give you one in July, but don't expect one at the next meeting unless things continue to justify our viewpoint. And by the way, part of what we're doing here is kind of normalizing rates, just taking a little bit of the edge off, and we think that that's how they go. They get 75 basis points in starting in July, but obviously, the risks are skewed, we think, toward later and less. We agree with the markets on that point, but from where we sit, we think the Fed is going to have sufficient justification and to be able to get at least started in July, and that it will ultimately be a little bit of a positive surprise once they start signaling that is going to come in. We think that that's probably going to happen either at the June meeting or shortly thereafter. So no, it's not a give up hope kind of scenario, but ultimately in the longer term, as we said, our medium to long term view is that we are in a slightly structurally higher inflation environment. That means that the neutral rate is higher, that the Fed won't be in a dramatic and swift. It'll be a very cautious easing cycle that the Fed sort of eases into. We think that in the back half of the year, a little bit more softness in consumers. We've seen service sector PMIs come in a little bit here, and we think that foretells a little bit of the consumer. Not exhaustion, but a little bit of incremental consumer weariness as their COVID savings get burned down, and that's that the consumer has really been hanging tough. So that's a pretty impressive. But we think it's incrementally things aren't getting easier for the consumer. And so our viewpoint is that around the time that the Fed cuts rates in July, this is kind of when a big market driving macro event comes clearer onto the horizon, and that's obviously the election. I'm sure that, so many people on the call are, trying to stuff cotton in their ears rather than hear anything about politics. And so we won't talk politics per se, but we'll talk sort of policy contrasting. Obviously, what we saw in 2020 was the kind of typical motif around, July, August kind of time frame is when the election is in, close enough. It's an investable time horizon that you can begin to price in outcomes from the election. The polls matter a little bit more than, although everybody agrees the polls are pretty faulty these days. But we think that, once the Fed gets their July rate cut, it will, maybe signal that it's going to take a little time off and let things play out from there. And we think that the market attention will shift to the polls and the competing economic proposals for each candidate. So we've gotten some clarity on where both candidates stand. Some of these are, these policies aren't set in stone. President Biden has put out his plan, his budget. Obviously, it's not going to pass now, but the idea being it's a statement of policy, and it's relatively balanced in terms of the fiscal approach, right? It's the sort of classic motif of tax the billionaires, let the Trump tax cuts expire, and then do a little bit of spending in terms of the child tax credit, in terms of home buyer tax credits, stuff like that. Ultimately, it's supposed to be a fiscally more conservative, with, I think, like $3 trillion of savings. Make sure my numbers aren't too far off, but a $3 trillion of savings over the time horizon, and budgeted in, and that's kind of typical sort of politics. That's not really going to be, if Biden is leading in the polls by the end of the summer, that's not going to be particularly upsetting to the Treasury market. It may not, necessarily equal incremental positives for the stock market, but it would be relatively soothing to the Treasury market. It's sort of a stable dollar, and the expectation, obviously, that is baked into a Biden win would be that the Democrats probably still lose the Senate, and so there wouldn't be, a lot of every single item on the wish list of the Biden agenda would get through. So we think that a Biden lead in the polls, which is not what we're predicting necessarily, but we think that if that's the prevailing dynamic through sort of August and into September, then we think it's probably a wash for the stock market, and relatively more stable for the Treasury market, and it's not a big dollar swing. We think that the Trump presidency, like a second term, would be very much like the first term, in that it's kind of a fat tail dynamic, right? All else being equal, the Trump policies are very stimulative, massive. He's, obviously the headlines are suggesting he's entertaining the idea of a flat tax, 17% tax. Some of his advisors are advocating. He certainly would extend the Trump tax cuts. Those are very beefy, and he wouldn't, and clearly, in terms of the pay fors, right, those are very wishy-washy sort of expressions of, well, maybe we'll cut entitlements. I don't think he's ever going to cut entitlements. So, and I don't think that those would be particularly credible. He's certainly not going to talk about those a lot on the campaign trail, even if he intended to do that. But I think that, that along with the tariff, the expressions of intent on raising tariffs and cutting down immigration, this is you can see how these policies would be, particularly if you're in a sticky inflation environment, tougher certainly than the Biden agenda for Treasury markets to digest. And so, in our view, a Trump lead in the polls, or the market's pricing in a Trump win, all else being equal, would be great for the stock market, but the problem would be the Treasury market. And if the Treasury market begins to get, unconcerned about the fiscal outlook, concerned about the inflationary consequences of some of these policies, that'd be a clear and present danger potentially to the stock markets. What otherwise might be a sort of a Trump bump in the stock market going into the election. So that's certainly something that we're watching very closely. If Trump is leading the polls and the Treasury market somehow stays on side, well, you could certainly see a much more positive reaction in the stock market. You could see, the dollar, holding steady or going lower. But that's not our base case. We think that, a Trump lead with the kind of economic policies he's touting would be much, much more difficult for the Treasury market to digest. And the question would be, how much pressure does he put on the Fed? He's obviously expressed his interest in getting rates lower and so forth, in sort of a damn the torpedoes kind of approach, which is his signature style. So we think that there are guessing games. So just to roll the tape back, we think that there are guessing games about what the Fed is going to do as sort of primary, and this waxing and waning concern about stagflation into the early part of the summer, which keeps the equity market kind of choppy and Treasury markets, basically Treasury yields supported. But we think that the Fed ultimately does begin to deliver and signal that delivery in the early summer. Then we think that the baton in terms of big macro drivers is passed on to the election, and it really depends who's in front. Who do we think, you got to have a view. What do we think is the outcome? Our base case is that Biden wins, and he wins with a divided Congress. And all else being equal, that's, a lower volatility kind of dynamic. Obviously not the best case scenario for the stock market, but maybe the best case scenario for the Treasury market, and that and Treasury stability feeds into at least it's something in the positive column for the stock. Let's see, when we look abroad and look at the state of the world, obviously geopolitics is a huge problem. We think that geopolitics is part of the stagflationary, mild stagflation dynamic that we see over the next few years really is underwritten by some of this geopolitics. We think that some of the other factors of the pendulum swinging back in terms of labor unions and labor power. The major dynamic at play is the deglobalization, reshoring, friendshoring, and pulling in the U.S.-China rift. We think that that's very, very inflationary for the West in general, and just the green transition that's expensive, so we think that inflation does stay sticky, and that geopolitics, oil. Our view on oil has been that it will be high and range bound, not going into nose bleeding territory, but it's going to stay supported by geopolitics and capped by a pretty responsible. Relatively responsible OPEC, and the cusp of demand destruction that I think a lot of the world is on and would be facing if you saw higher oil prices from here. And China among them. China's economy is something we've been very skeptical about how the Beijing's turn to stimulus would gain traction. We thought that it would be another one of these flash in the pan. The market rallies for a month or two on the back of this big pivot towards stimulus, and then that stimulus never really pays any dividends. You don't really see it in the growth numbers past maybe like a month or two, and the stock markets in China fall back down. That's essentially the playbook that we're seeing right now. We think that Chinese equities remain dead money. We're not particularly positive on the renminbi until the Fed starts cutting rates in July. We think that the dollar will get a little bit we'll head down a little bit, get some strong dollar relief from the strong dollar on the back of that. But we're big China skeptics, and we don't think that either the Trump administration part 2.0 or the Biden administration second term would be particularly great for China. Varying degrees of negativity and prioritization of what each of those presidents would hit when it came to China, but it would be a lot more sticks than carrots each side. Lastly, we're not worried about the yen falling out of bed. We think that the Japanese are, essentially they've marshaled enough political capital with the U.S. that they're not going to take a beating from the Treasury Department when the yen. They're essentially unwinding the Plaza Accords is what they're doing, and they're our most important ally in Asia. So the Treasury is going to give them a ton of rope, and with the BOJ now, in purportedly tightening mode, that's stabilized the yen to some extent, but we don't think that their inflation is low. they're still an export economy, and we don't think that they're in any way, deeply troubled by the direction of the yen weakening against the dollar structurally. It's only the pace that they're worried about. And we think that, when it comes to, the US, they're going to be on side with keeping that pace, jawboning and that sort of stuff, maybe even allowing a little bit of intervention if needed. But we think that the yen is on a one-way ticket to, back to a much weaker setting. Anything we're forgetting, Brendan? Oh, you're muted, Brendan.
Oh, sorry about that. No, I think that's kind of the big stuff.
John, you mentioned that the Biden administration would prefer maybe the rate cut to be earlier, like away from the election, maybe like July, not so much September after that. That's what he would like. Is it kind of like Powell is in lockstep knowing what Biden wants? How much communication do you think there is? Or does Powell completely get it in terms of, I don't know, you get what I'm saying? Like, how much is this independent, the Fed, and what they're going to do based on what they see as inflationary numbers? They've always said that, rate cuts or no rate cuts will be dictated on inflation. But, the idea that we want to get maybe a rate cut in well before the election is more of a political move. What do you guys think about that?
I think that the Fed, if anything, the Fed would try to err on the side of, looking less politically influenced. Whatever they do, Trump is going to whatever, right? And so they're not going to insulate themselves from political pressure by not cutting in July is I think the basic idea. And I think that the Fed, as Brendan said, has set the table for cuts and is really going to be in a position where we think that the data is going to turn in their favor, over the coming months, and they're going to have enough justification to begin. And, essentially, if they cut in June, cut in July, cut in September, or any of those months, they're going to get dumped on by the Trump administration. I mean, the Trump campaign, right? And he's already said that he's not re-upping Powell. So, I think that the Fed and the Biden administration are not in cahoots on this one. I think that, the political calendar and to, get your policy direction set ahead of the election is just sort of standard operating procedure. Mm-hmm. And they're going to get, whether it's June, July, September, any rate cut before the election is going to open them up to a broadside from Trump. So I think they're just going to, cover their ears, hold their noses, and just follow the data. And I think the data allow them to cut in July.
And if you're someone that cares about Fed independence, Powell kind of is the perfect guy for the job right now. He's lived in DC and understands the politics side of it. And he also knows, either way, this is his kind of the end of his term of running the Fed. And I think he very much cares that his legacy is, that he maintained Fed independence in, somewhat of a difficult time.
Yeah, I mean, just to roll the tape back, when he was, so when we were...
He's also a Republican.
What the Fed was doing. Yeah, when we were watching what the Fed was, I remember joking with Brendan when he hiked rates in that rate hike in December in 2018, and I joked, that market just fell out of bed. It looked an obvious mistake. The Trump administration freaked out, and I remember joking to Brendan that Chair Powell is never, ever going to cut rates ever again, ever. I mean, hike rates. I was wrong. And he did end up hiking rates, although very grudgingly. But, in DC during that 2019 rate cut cycle, which was essentially, to inoculate the US economy against the risk of a trade fight with China that Trump started, the Democrats were in Washington, DC saying, like, why is he cutting so aggressively? Is it because Trump is breathing down his neck? And, our take on it was, that's probably a factor. I mean, it was a very, the Trump administration was not shy about throwing the rule book and sort of the niceties and norms of Washington, D.C. out the window in a lot of different situations and a relationship with the Fed, why would that be any different? And I think that probably if you asked former President Trump, what would you do? What are some of the things you do differently in your next term? I bet he would say, I would never let the Fed get away with, the level of independence that they had, which is essentially what he said.
He wouldn't have reappointed Powell. Yeah, that's probably a top list. Yeah.
So he's not going to reappoint Powell, and so what does that mean for the Fed? Can he actually if Powell is so disfavored and pressured, will he stay in his seat if he's not really serving at the pleasure of the president? So we don't think that the Biden administration is operates in the same way. They still try to. Biden's an institutionalist. Trump isn't, and one set of playbooks for the institutionalist when it comes to Fed relations, and the other is it's essentially no holds barred. Got to get the Fed on side with your policies. So,
one question is, so obviously, if Trump were elected, there's no question we'd be drilling a lot more oil on our homeland. What about that's effect in reducing inflation, and how that could be a solve for, keeping inflation at bay, reducing the cost of oil going into 2025?
And that's part of the so one of the things that is so I think it's a really great point. And the idea of the Trump administration trying to keep the Treasury market on side with what would be one would assume an extremely stimulative fiscal posture in an environment where you have let's assume we have sticky inflation, or a relatively recent, if inflation is back in the target, it has only gotten there relatively recently, and the expectation is that it's not going to be at target. And so to throw a ton of stimulus into that, plus tariffs and so forth, and maybe to pressure the Fed to cut rates and perhaps succeed in getting the Fed to cut rates, faster than they would have otherwise done so with absent political pressure. I mean, it would be very important for the Trump administration to try to keep oil prices down. And that's one of the factors that could keep the Treasury market on, or help keep the Treasury market tamer in the face of this significant stimulus that would be coming through. The big question, and there are people that know this a lot better than I do, U.S. production is doing well right now.
We're actually at record highs. So, well, I do think
the question is how
make permitting a lot easier. I'm not sure that the private market would actually pump that much more because it could drive down the price of oil. So it's been a difficult part for the Biden administration. He knows he needs to keep oil prices down, so he doesn't brag about this, but we actually are at record highs because the environmental side of the Democratic Party is pretty mad about what's going on.
And if the U.S. if production does ramp up, then you got the OPEC factor, right? The question is, what does OPEC do? And you could say, well, he's got, Trump has a lot better relationship with the Saudis maybe than the Biden administration, but the Saudis have their own problems, right? I mean, there's a reason that they're keeping oil prices high. And the Russians are the same way, right? Do the Russians really want to see oil prices in the 50s and 60s? Hell no, right? They need it where it is. And so you could certainly see, if the U.S. were in production, you could certainly see OPEC just saying, hey, look, love to help you out, man, but we got to cut our output to balance yours and keep oil prices high. So I think that's a real wild card. And it's not clear to me that OPEC would play ball with the Trump administration to the extent that he would want them to.
Okay, great. Got a question from a client. With interest expense on public debt pacing to exceed the defense budget and possibly entitlement spending, how do you envision this influencing politics and polities in the next couple of years?
So we have I think we talked about this on our last CAPIS call. We have a way out of the money option on the Biden administration 2.0. So basically the thought experiment is, and apologies if you've heard us bang this drum before. This is not our base case, by the way. But when you look at the idea of entitlement reform, the what kind of administration is going to get entitlement reform done, right? You would have to have the political stars would have to align perfectly, right? And what that perfect alignment might look like is, let's face it, second term, senior statesman, record of bipartisanship, and we think they have to be a Democrat, which sounds weird, but if a Republican tries to cut entitlements, they will be met with a united wall of Democrats absolutely, taking maximum political advantage of it. So this has to be a Nixon in China moment. You have someone with, essentially like liberal bona fides that are beyond reproach, looking at the problem as a senior statesman in their second term with a record of bipartisanship and saying, look, it's time to grow up. As we've got to grow up here in Washington, D.C. We all recognize that this is a problem. We actually have to do something about it. We have to raise the retirement age. We have to somehow make sure that Social Security is going to be there for the future generations. This is going to be my legacy. That sounds to me like something that a second term Biden presidency could actually, he's closer to that kind of formulation, and he's going to have a divided Congress. What else is he going to get done, right? This is also, I'll go back to the initial caveat. This is not our base case, but if anybody is going to be able to cut entitlements, it's going to be someone like a Joe Biden who can sit there and talk to the American people and say, look, we've got to do this. We've got to reach across the aisle. The left wing of the party hates him already. And so he'd already be in a second term. Right. And so that would be the only way that we see that happening. If President Trump comes in and tries to cut entitlements, he's going to have slim majorities, and the Democrats are going to form an absolutely united wall. They're going to demagogue that issue to the nth degree, and he'll never get it done. Never. And so we think it's a very, very narrow path. We think it's not our base case. It's unlikely, but we think that kind of, there's almost nothing other than a crisis that could lead us to like actual sensible entitlement reform rather than, some sort of formulation politically that looks like the scenario we just drew up.
Yeah. You need more baby boomers to die before that voting bloc.
And I just don't see entitlement reform. I don't know. It just doesn't seem like that's on the agenda for either of them, quite frankly. Maybe the guy that could get it done. I'm not saying he can get elected, but maybe the guy that could get it done is RFK Jr. He can't get elected, but he could get it done, possibly. Last question.
I think you need like a consummate Washington, D.C. I think you need a consummate Washington, D.C. operator, right? You need someone that can absolutely knows all of the levers to pull.
Yeah, especially in the Senate. Knows how to get the votes.
It can't be an outsider. It just can't. It's not going to work.
Then maybe it would have been Joe Biden 30 years ago. Last question. How many votes does RFK Jr. take away from Biden in November? A few? Hardly any? Does it matter?
I think it matters. Yeah. I think that there's definitely that's essentially, he is a spoiler candidate. Essentially that's who's funding him. The question is like, how many ballots can he really get on? And I think that's the tough part. He picked the vice presidents, Nicole Shanahan, because she has enough money to be able to fund some of these efforts to get on the ballots in some of these states. I think it's really hard to get on the ballots. If he's able to get on those ballots, then he could be easily be a swing factor, and essentially deliver the kind of formulation that gets Trump over the top.
Yeah. From the last two elections, you saw this election really comes down to somewhere between 5,000 to 30,000 votes in 5 to 6 states. So it's that close. So if he could take away, 5,000, then it can swing that, like a Wisconsin or something like that, one way or the other.
Absolutely. And it's going to be really interesting. I mean, we've just got so many unprecedented variables coming into this election cycle. It's going to be, a pollster's nightmare, and it's going to be hard to, it's really going to be hard to handicap this thing. But the polls right now, maybe, I'm sure they're way too far out for the polls to matter at this point, and the uncertainties of and it's not just RFK Jr. as third-party candidates. There are others. There are others potentially out there. So, but yeah, it's a really big concern for the Biden campaign, and it should be.
Mm-hmm. All right. Well, thank you so much, guys, for your insights. We really appreciate it. It's awesome to have you here today.
Yeah, you bet. It's peering into our crystal ball. It's definitely a pretty cloudy.
That's what we want you here for. That's good. No, it's like you said earlier, you have to have a view, and no one has that 100% crystal ball, but with your experience and insight,
it's still so early,
It's great. Yeah, it is early, and a lot's going to happen the next
September. We'll have a much more clear view or opinion on who we think is going to win. But
that's right. The next time you're back on, we'll be that much closer to things formulating, and it'll be exciting to have you on to discuss that as we get closer.
So much can happen in the next 4 or 5 months.
Absolutely. Well, thank you, CAPIS clients and friends that joined us for the call today. Next month, I believe we're going to have Katie Stockton, who will provide technical analysis insights on the markets, and we'll get that date. We'll get that date and invite to you soon. And everybody have a great day. And Markets Policy Partners, thank you so much. Appreciate it.
Thanks, everybody.